Okay, you can start. Fine.
Yeah. So I would just share the screen.
You can share.
Yes, sir. Just so is the screen visible?
No, it's coming.
So hello everyone. I'm Abhay, and today we are going to learn about something that every business deals with. That is depreciation. So you must have noticed that our value of our phone, our bike, be it our car, over time the value gets reduced. That is depreciation. In real life, the value depletes over time. It may be due to certain factors. So, in this class, we are about to learn about the definition of the depreciation, what are the causes, and what are the methods that we can account depreciation. So, let's move on with the class. And I wish to teach in certain way with certain real life examples that we would be able to understand easily. So, let's move on to my presentation. So, what is depreciation? So, if you see in real life, the value of a certain asset we use in business is getting depleted over a period of time. So, if we read the definition of depreciation, depreciation represents the systematic allocation of a fixed asset's cost over its useful economic life. The thing is, in businesses, when we use a particular asset, the value of the asset depletes over time. Like if we buy an asset for 10,000 pounds and after 5 or 10 years, the value won't be the same, right? So the system, for the right allocation of that cost, we need to use this term depreciation. So in here you see the systematic allocation, value reflection. The assets worth, if we calculate depreciation properly, we will after 5 or 10 years, we would be it would be easier for us to reflect the right value of how much that asset is worth. And we have to we have to use the matching principle in accounting. We have to align the cost or expense in that right accounting period too. So for that, depreciation is needed. And if you see, the most of the tangible assets, that is non-current assets, from machinery to vehicles, don't maintain their original value. They have a certain amount of depreciation, right? They lose their value over a period of time. So for that, we must calculate depreciation, and it plays a huge role. If we see the financials of a business, we must, after a point of time, we must allocate the depreciation. In every accounting period, it's a really important factor. So to know what is depreciation is an important factor for us as finance professionals. It's really important. So if we see, it's not about just the physical deterioration alone, but rather a method of matching expenses with the revenues. If you see, if I buy an asset, for example, if I buy a printing machine, I have a newspaper printing business, and if I buy a machine which prints newspapers, uh, the the income I'm generating is due to that machine, right? So accordingly, if there's an cost or any such expense, we should match that cost and revenue in that particular accounting period, right? We can't just account it 5 or 6 years later. We have to match that expense in that period itself. So that is why this matching principle is used. So I personally went through the textbook that I had, the syllabus that I needed to talk, and these were the syllabus, these were the stuff, these were the topics that in the textbook they shared. So this is the topics that I should cover. That is, what is depreciation, how it is accounted, what are the methods, what are the causes of depreciation, and also why it is necessary. So the key principle of depreciation, by spreading the assets cost across multiple accounting periods. If you see in finances, the exact amount, the accurate amount is really important. So in every accounting period, if we post the depreciation in a correct way, the exact profit would be allocated. So depreciation ensures financial statements accurately reflect the true cost of generating revenue. If we go back to that example, like that printing machine, if I'm allocating just the revenue, there will be this excess revenue, right? So if you only we allocate the cost to, then only I can get the accurate profit amount. So what is meant by depreciation? I hope you guys can understand that. The thing is, in real life, if I can just say an example, if I buy a car, after 1 year the value won't be the same, right? If I buy a car for maybe 10,000 pounds, it won't be the same. It won't be the same after 1 year. So to understand what is depreciation easily, the difference of maybe the car can be sold for 6,000 or 8,000 pounds. If you're considering 8,000 pounds, the difference, most probably the difference would be due to depreciation. And if we look what causes depreciation, we should move to the other slide. Causes of depreciation. There are various causes. If you see, there are many causes, many reasons by which depreciation happens. So one of the most common, if we go back to the previous example, um, my printing machine would be used 24/7 throughout the year. So there would be some physical damages and all. Mm, the screws might get loose. There might be some issues. There might be some issues with the coloring. So that is called physical wear and tear. That is, continuous use causes mechanical parts to deteriorate, surface to erode, and components to weaken. If you see, I have this business of mm, transportation business, and I have this fleet of buses or trucks. Let's go with the buses. If the buses, if the buses, I just use those buses to transport people, or use those trucks to transport goods to wherever. If I use it for a long time, the vehicles might have certain issues, right? The efficiency they provide at the first year won't be the efficiency they have in the 10th or 20th year, right? So, what is meant by physical wear and tear is gradually the machinery, vehicles, or equipment lose their efficiency and functionality through daily operations. As I'm operating, if I'm operating anything, be it any machinery, if I'm operating daily, there might be certain wear and tear due to my use or due to the continuous use. So sometimes the things might get hot and the things might get worn out. So that physical wear and tear, that due to that the efficiency is lost. That loss of efficiencies can be considered as depreciation of that item. And obsolescence. This is if I'm giving an example. If you see, right now I'm using an iPhone 11, and currently there is iPhone 17. Even though I can use my iPhone 11 still now with whatever I want to use, the thing is, it's quite outdated. Comparing to the iPhone 17 that's out there in the market, iPhone 11 is a little bit outdated, right? So even that can cause a loss of its value, despite it remains functional, but still the value got lower, right? So that can be a reason for depreciation too. So if you look at the definition of obsolescence, technological advancement renders assets outdated before physical deterioration occurs. Here we said that physical deterioration or erosion might cause depreciation, but also if there's a technological advancement in any machinery, we might, the value might deplete, and we should consider depreciation. That is also a reason for depreciation. So if you see, the majorly computer system, software, or even manufacturing equipment are also subject to obsolescence. Because if you see, I've got a machinery in 2010 that manufactures, beat anything. It manufactures a pen. So in 2010, the machine could manufacture around 100 or 150 pen at one run. Currently, in 2025, there's another machine that can manufacture pens like 200 or 500 pens in one go. So if you see, even though my old machine is functional, but it is not economically viable despite remaining functional. So that can be a reason for depreciation too. And another reason, passage of time. So this is kind of similar to physical wear and tear and obsolescence, but here the passage of time is completely different. The thing is, I should say that with an example. If you see, I bought this machinery which manufactures pen, and I didn't use it. I didn't move it at all. Like I just kept it in one corner. I just kept it here, and I just kept it without using it. So it stays idle. I don't use it, but the thing is, the materials age, warranties expire, and market preference to ship. Even if I bought this particular iPhone and as a box piece, I just kept it there. Would I get the same value as if the phone got released in, I guess, 2017 or something? I won't, right? So even due to passage of time, the loss of value might occur. If you see, another example is that I bought a car, and I just kept it in my home, in a glass box. Even even if I'm able to sell that car, I won't get the same value as I'm getting right now. So if you see, let's read the definition. Even idle assets depreciate as materials age, warranties expire, and market preference shift. Time-based factors like rust, decay, and changing regulations. This changing regulations is a big deal because if you see, if I have some manufacturing equipment and there might be a usage of energy, right? And if there's a high usage of energy, that might be a problem too. Because as we move forward, and there will be many technologically advanced products like literally anything, be it anything, all these technologies coming up. And as we move forward, the old machines would be, a bit lagging behind, using more power or giving less output. So due to that, to the value changes. So that's one such reasons. First one was physical wear and tear. Second was obsolescence, and third was passage of time. Then another one is accidental damage. So let's just imagine we bought a car and there was a sudden rainfall and it started flooding in our area, due to which the value of our car would be, a bit less, right? If we compare it to the other cars, the value would be less. So that is a reason for depreciation. Beat anything. If you see the flood affected cars goes less price, right? So like that, if we have a machinery, if we have a factory which manufactures something, maybe you know book printing or some any factory, and in that factory we were going well, we were going profitable, but all of a sudden there was an earthquake or even a short circuit, and certain machines got affected with it, and their performance started affecting. That can also be a cause of depreciation. Due to that, it can accelerate depreciation beyond the normal expectation. Normally, I used to calculate depreciation of those machines in a particular manner, but after this, the efficiency started dropping. So when the efficiency drops, the I won't be able to generate the same revenue as I used to. So we have to, calculate the depreciation accordingly and account it. So these are the reasons on causes of depreciation. Let's read and just revise again. Assets lose value through various mechanisms, both predictable and unexpected. Understanding these causes helps business estimate useful life and select appropriate depreciation methods. So these are the four reasons that majorly depreciation can occur. One is physical wear and tear, another is obsolescence, passage of time, accidental death. Physical wear and tear means due to the continuous usage, there might be some damages. Obsolescence mean technologically advancement. If we, the best example is that iPhone case, or be it any mobile phone case, or any technologically, any technological stuff, or be it any machinery. To remember, I guess it's the best is the iPhone. Currently, I'm using an iPhone 11, but there's an iPhone 17 out there in the market, and the value of the iPhone 11 won't be the same as I bought it. So that difference is, so that are the basis we can understand. Depreciation, if we imagine that's a big thing, you shouldn't consider it as a big thing. It's kind of easy to understand if we understand it with the real life examples. When a teacher taught me depreciation, he was completely saying all these technical terms, and or even if he was giving some examples, I couldn't really understand. But when I started learning, a friend helped me to understand depreciation. He taught me in a way that with real life examples and all, and that helped me to understand all these. So it's not a big thing. Just gotta understand what happens and all. That's it. So let's move forward now about depreciation method. There are different methods to calculate depreciation, and one is straight line method. So why we have to calculate depreciation? I've said that we must, while running a business or while managing the finances, we must know the we must know the accurate result. We can't just randomly say this is my profit, this is my thing. They have to be accurate. So business have several approaches to calculate depreciation, and each of these methods you know calculate the depreciation in a different way and provide an economic benefit in a different way, and that impacts our financials. So and also the tax obligation. If you see uh, about the tax obligation, mm, if I have a profit of any particular amount, and that might be taxable. If I'm able to, reduce that amount, I would get less taxes, right? So tax planning is an important factor too. We can talk about that later. Now, just let's just discuss about the depreciation stuff. About straight line method of depreciation. If you see, as the straight line goes, it goes in a straight pattern. Like it doesn't go like this. It doesn't go in an upward trend, right? Upward or downward trend. It goes like this. So as the name suggests, straight line method of depreciation allocates equal depreciation expense each year. That is, if I bought a particular machinery for 10,000 pounds, that shall be divided by its useful life. If I bought a machinery for 10,000 pounds and its useful life is 5 years, so purchase price minus salvage value divided by its useful life is the rate of depreciation. I would show you that formula. So if you see straight line method, it is the most common approach to. If you, why it is common? Because if you calculate the depreciation once over its useful life, the same depreciation allows. So if you see, the formula is cost minus salvage value divided by useful life. So about cost, what is cost? I hope you guys know that the cost of a particular machine is its purchase price and installation cost. So why is that installation cost considered? So if I mm, if I I should say that with an example. If I bought a machinery, and if I brought a huge plant and machinery, it should be installed, right? So why installation cost is considered to be? the cost of the machine or plant is, installation is important, first of all. And to make a revenue through that machine, without installing, I can't do that, right? So installation cost is also considered as the cost of the machine. So what is cost of the machine? The purchase price of the machine plus the installation cost. Installation or fixation cost. We usually use the term installation cost here. So that's why purchase price plus installation cost. So that is the cost of the machine. So here, formulas first part, cost of the machine. For cost, just the purchase price of the machine plus the installation cost. The installation cost is important because if I wish to earn a revenue through the machine, the machine shall be installed. So the prior installation cost shall be included. Maintenance cost is excluded; it's not included, but the installation cost is important. So you should keep in mind that if you are determining the cost of the machine, you should consider purchase price plus the installation cost. Then minus salvage value. I hope you guys know about the salvage value. So what is salvage value? Uh, so let's consider I'm buying a machinery for producing any product. I have installed it. I have kept it in my factory and it works for like 10 or 20 years. After 20 years, the machinery is not good for using. Its purpose is over. Its useful life is over. And there would be some, items to salvage or sell as scrap or anything, right? So if I buy a machinery which is made of metal, I can literally salvage it, right? I can sell it. I can just scrap or sell it. So that value is called salvage value. Expected value at the end of its life. You know, so we learned two things, that is determination of cost and estimated salvage. So initially we do that with an estimate. In practical questions, the salvage value would be given, and I guess purchase price and installation cost shall be also given. And maybe in practicals there might be other costs too, but we should just focus on the purchase price plus installation cost. Okay. Now about salvage value, why it is considered. Even if I'm salvaging or selling that machinery as scrap or residual, it is still a revenue for the business, right? So I'm earning through that machine. So if I'm earning through that machine, it's not a cost for me. So I have to reduce that. It's as simple as that. We just know that businesses just want to earn the revenue and provide a service. So with the machine, I'm earning the revenue, and also at the end of its life, I'm selling it and earning a revenue. So I'm reducing that revenue from the purchase cost and dividing it throughout its life to get the depreciation through straight line method. Okay, useful life. Now about useful life, if you see years of productive service, uh, if I see, that can be determined by many factors. And if you see, I bought that machinery for printing newspaper, and there might be similar machinery in the market, and we can get an approximate value that I can use this machine for X number of years. I can use this for 5 years or maybe even 10 years. So in that way I can understand. So with that calculation, we are able to find the straight depreciation through straight line method. So if you see, I've got a practical example. So I bought a machinery that costs around 10,000 pounds. Asset cost is 10,000 pounds, and the salvage value at the end of its life is 1,000 pounds, and useful life is 5 years. And if you calculate it, 10,000 minus 1,000 divided by its useful life is 1,800. That is the annual depreciation. You can ignore this part because it's nothing, just the depreciable total depreciable amount by useful life. You can just ignore this part. At the end of its life, we might calculate how much the annual charges of that machine was. In practical, there might be maintenance charges too, so can ignore this fourth part. I just kept it for the understanding. That's it. So if you see, asset cost was 10,000, salvage value was £1,000, and the useful life was 5 years. So 10,000 minus 1,000, we got a particular cost divided by its useful life. We got the annual depreciation, and we have to charge that annually. We would come to the charging of depreciation. So the definition of straight line method. The straight line method delivers consistent, predictable depreciation expense across every accounting period. I hope you can understand that. In this case, the 10,000 pound machinery is, its useful life is 5 years. So throughout these 5 years, this depreciation part won't change. You have to keep that in mind. In straight line method, equal amount, consistent, predictable depreciation expense across every accounting period. So you have to keep that in mind when a question comes with straight line method. The depreciation the amount of depreciation won't change no matter what. Might There might be if you see, if there's an advanced level question in certain companies or certain factories, the there shall be an assessment done by which the useful life of an asset shall be determined. It's a bit advanced, but in certain cases, if just an example about our newspaper printing company. If you see the machine I bought, when I bought the machine, the useful life was just 5 years. And later on, I kind of surveyed and just checked the condition of the machine. And later I realized that I can use it for 8 years. And in those cases, the straight line method, if I'm following straight line method, the calculation might change. So that's a bit advanced level. I guess it's better suited if I teach that in a question. If there's a question, I can teach that a little bit more better. So I guess I hope straight line method is clear. We can just just brush up the terms. Straight line method delivers consistent, predictable depreciation. So once we calculate the depreciation, it is consistent and predictable. It is same in every accounting period. So the simplicity makes it preferred choice for the assets that deteriorate uniformly. If you see, I have given examples here. Certain buildings, furniture, and equipment that provide steady benefits and lose value evenly as office fixtures, straight line production machinery, or property structure. Certain type of machinery, if you see, if I have a chair in my office, uh, you know, the purpose of the chair literally remains the same. The usage remains the same. So to calculate depreciation, I would suggest straight line method because there's no issues with that. Because I can literally be predict depreciation. That's it. That's straight line. So in simple terms, it won't change no matter what. It moves like a straight line. In every accounting period, it's the same. So let's get back to the theory. Allocates equal depreciation expense each year throughout the useful life. So I hope straight line method is clear. Just got to understand that in accounting, in straight line method of finding the depreciation, it doesn't change. No matter what, it doesn't change. It's simple, predictable, widely used for assets that provide consistent economic benefits. So it's simple as the calculation is really simple. And once done, we don't have to repeat that unless there is a change in useful life or something. Easily predictable because once we calculate, it's literally the same throughout the other years. And yes, widely used for the assets that provide consistent economic benefit. If a product is giving the same revenue, same purpose, we can use straight line method. Now moving to the another other method, that is reducing balance method. Applies a fixed percentage to the declining book value each year, resulting in higher depreciation initially that decreases over time. I have made another presentation for this. Just a minute. Reducing balance method. Just a second. I'll keep this here. So theoretically, an accelerated depreciation approach that recognizes higher expense in early years. I can just show you my example. So in straight line depreciation, what happened was the depreciation was of the same amount. Here, how it works is we must calculate depreciation with a fixed rate, fixed percentage. You see the book value at the beginning. If I purchased an asset for £10,000, the thing is the depreciation rate would be given. If the depreciation rate is given in a particular question, it's always reducing balance method or written down value method. Okay, that's the other name of the reducing balance method. So what we should understand is in straight line method, they would give us the just let me they would give the cost, salvage value, and useful life. In reducing balance method, they would just give us the cost. Sometimes even the this would be given like useful life would be given. But here, if the rate of depreciation, if there's a fixed rate for depreciation is given like this, we must follow reducing balance method. We see in practically in most areas, reducing balance method is used because if you see every machinery works in a different way. The plant and machinery works in a different way. This laptop works in a different way, and the damages that can come come in is also in a different way. So if we calculate the depreciation through straight line method, it won't be accurate, right? So for a better result, practically this is used for different sets, different percentage of percentages used. So how it works? The formula is depreciation. If we let's just read the definition. Rather than depreciating a fixed amount, reducing balance method applies a constant percentage to the diminishing book value at the start of each period. If we see, let's just see this example for a better understanding. The asset costs £10,000 and the rate of depreciation is 20%. So for the first year, there's no confusion. We can just, £10,000 into 20%, that is 2,000. But what is the difficult part here is sometimes when we are so used to that straight line method, we might think the next year's depreciation would be £2,000. But the thing is, the next year is 1,600. Why that happened? Because what is written here, reducing balance method. So first year the value of the asset is 10,000, and there's a depreciation of 2,000 in that machinery. So the second year, in year 2, the value won't be 10,000, right? In first year it's 10,000, so in first year it's 10,000. There has been a depreciation of 2,000. So in the second year we should consider this depreciation, and the value would be reduced, right? The machine was costing 10,000, or there's a depreciation of 2,000, and when we subtract this from this, we got the 8,000. And on the second year, in reducing balance method or return down value method, WDV method, we must calculate the depreciation with this 8,000. That is the 20% of the 8,000 pounds. So the next year's depreciation would be £1,600. And from so if we apply that for the third year, from 8,000, we have this 1,600 as depreciation. We must reduce it, and the next year's value would be 6,400. And on that value, the third year's depreciation is calculated. So if you notice this trend, first year is £2,000, second year is £1,600, third year is £1,280, and the fourth year is 1,024. As the value to, if you notice the value of the value of the asset, first year is 10,000. After that, there is a depreciation of 2,000, and second year the value reduced. the balance of the machinery's value reduced. As the name suggests, it is called reducing balance method. You see, first year 10,000, second year 8,000. The value of this particular machinery reduced reduced through depreciation. So here, rather than depreciating a fixed amount, reducing balance method applies a constant percentage, 20% is same in every year. But to the diminishing book value, you see, notice that wordings, diminishing book value. That is, in first year, the value was 10,000, 2,000 depreciation, and 8,000 was the next year's value. And after that, on that value, 8,000, we must calculate the depreciation. That is 1,600. And if we reduce that value, 6,400. And on the third year, we must calculate that 20% on 6,400. That is how the reducing balance method works. Now, about the applications. If we read the definition again, an accelerated depreciation approach that recognizes higher expense in early years, diminishing the, just a second, sorry. Yeah, we can talk. We can continue. An accelerated depreciation approach that recognize a higher expense in early years, gradually diminishing as the asset ages. This pattern mirrors reality for asset losing value rapidly when we have a car, it loses its value over time, right? As we use it, you know, it loses its value. In the first year itself, I bought a car for, you know, 10 lakhs. And by using it 1 year, suddenly there would be a reduction of 1 lakh or 2 lakhs, right? I won't be able to sell that for the same amount. So that rapid change or rapidly losing value, this reducing balance method works. So ideal applications lose value rapidly when new, be it vehicles, be it technology. Talking about technology, um, let's talk about the iPhones because I guess it's quite understandable in that way. Recently, the iPhone 17 launched. It's 2025 and iPhone 17 is launched. Maybe next year or in 2 years, the 18 models would come. So when the iPhone 17 launched, they had this particular price, right? Would it be the same even after 2 years? No, right? So they lose their value rapidly. And everything, the things, all those, be it a phone, be it a laptop, be it a car, they lose their value in different ways, right? If you see, all those things require maintenance too. If the depreciation is literally the same every year, so even the maintenance would cost, right? So if the depreciation is different in different years, if you see into in a year one, the depreciation is 2,000. In year one, if I let's just go with an example. I have this, I have a car and I bought it for, let's just be a fictional amount, 10,000 pounds. I have bought this car. And the first year depreciation was 2,000. And during the first year, I didn't have much maintenance, right? Hmm? As they age, they require higher maintenance. If I, service the car for like maybe 100 pounds, and in 5 or 10 years, it won't be the same. Like I would require a higher maintenance cost, right? So this is a better way to, in practical, in real life, I guess they in everywhere they practice this method. And also these are just the costs that can cost, depreciation costs and all. And in this way, if we just imagine, I have just started a business and I'm earning a lot of profit, but all those profits are taxed. You know, I'm paying a lot of tax too. So in the initial days, if I have less profit, that is, this depreciation is a non-cash item. Hmm? It doesn't affect our cash flow. So the advantages that reducing balance method provides is that it provides a higher amount in the early years. You see, later on, the depreciation amount reduces. So, as depreciation is a non-cash item, and if we calculate properly and initially, uh, it provides a higher amount. The cash flow is not affecting but the profit. As finance professionals, we know that depreciation is a non-cash item, and you know it doesn't affect the uh, cash flow. So while considering our profit, like for considering our profit for taxation, if we reduce depreciation, our profits would be much less, and we don't have to pay a higher amount of tax. So initially, for me, if I start a business, initially it helps me a lot, and later on, as the revenue gets higher, depreciation does deplete, but we might change the machinery or something. There would be a change. There would be an obvious change. So that has it, like the tax advantage. Loading depreciation can reduce taxable income more significantly in profitable early years. In the early years of profitable income, we would be able to pay less taxes. So let's just talk about the differences. Let's just go through the definition again and then go to the differences. If you see, straight line method allocates equal depreciation. This depreciation rate won't change no matter what. For 5 years, it would be the same. And the formula to calculate this depreciation is cost minus salvage value divided by useful life. So if all these are given, that is cost, estimated salvage value, useful life is given, we have to calculate depreciation through straight line method. So when you hear this term, you should be obvious that straight line method is used. Cause in our question papers, what happens is they would just give the info and calculate depreciation. They might sometimes they might say that calculate this through straight line method or reducing balance method, but sometimes they won't. So if all these three are given, we should calculate in straight line method. But if you see a percentage and they just ask for what's the depreciation rate, or what's the amount of depreciation, we must calculate in this rate. But if they have given all this information, and if they have asked the question to be straight line method, we must calculate it in depreciation straight line method. So let's just read the definition again. Allocates equal depreciation. So whenever you hear the term equal depreciation, or uh, you know purchase cost, useful life, and salvage value, we must know that straight line method is used. Reducing when there's a fixed percentage, and initially there would be higher depreciation, then it is we are adopting a reducing balance method. In practically, if you start working and all, you would know that practically they prefer the reducing balance method. So here there's a key when to use and how these methods shall be used. The selection depends fundamentally on how the asset's economic benefits are consumed over time. If you see, if I buy a furniture for my factory just to conduct meetings and all, the consumption would be same. But if I'm buy a heavy machinery, the consumption would be different, right? So based on the consumption over time, it's decided whether straight line method is used, reducing balance method uses. These are just I'm just giving some additional information for you to understand what is straight line method and what is reducing balance method, so that there won't be any confusions in future. So this is such a way, and this is another way. Uh, and assets losing value uniformly suits straight line. If you see, the furnitures would lose the value in the same way. So uniformly, so in a straight line, that is they prefer straight line method, and other who declines rapidly with a particular rate favor reducing balance. Be it machinery, be it computers, if they have a specific rate, it's reducing balance method. And in most practical cases, reducing balance method is used. let's move on to the next one. Let's